You're about to join Niels Kaastrup-Larsen on a raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor Series.
Welcome back to this week's edition of the Systematic Investor Series with Cem Karsan and I, Niels Kaastrup-Larsen, where each week we take the pulse of the global markets through the lens of a rules-based investor. If you're new to the show, I hope that today's episode will trigger your curiosity enough to check out the back catalog and listen to the past episodes that you may have missed, like my conversation with Mark last week, where we naturally discussed the fallout on CTAs from the Silicon Valley Bank issue and a few other bank emergencies. We also discussed how we are in a period of, as Mark calls it, the great bond repricing and what that means for the economy more broadly, a topic that I'm sure we'll revert to later on today. Also, I very much would encourage you to listen to our midweek episode, which was highly interesting. It's a conversation for those who want to hear an alternative view in terms of the world's largest country. McKinsey said that we are living in the Indian century. Morgan Stanley believes that 20% of global growth in the next decade will come from India. But our guest, Princeton economist Ashoka Modi, has a different view, which he details in his new book called India is Broken. And this turned into a fascinating conversation with Kevin on the podcast. So head over and check that out after you've been listening to Cem and I today. Cem, it is wonderful to be back with you this week. How are things where you are?
Doing good. I'm actually at the Grand Canyon with my kids, believe it or not, looking out over the canyon. So hopefully inspiration today. No, it's been a while. It's wonderful to be back on.
Fantastic. Good stuff. Now, even though it's been a few weeks since we last spoke, within the last couple of weeks, I would say it has been quite eventful. We've had a few bank failures. We've had central banks continuing to hike. The last one came yesterday, where the Swiss National Bank went to 1.5%. Bank of England now is up to 4.25%. ECB 3.5%, and the Fed, of course, somewhere between 4.75% and 5%. Now, we are recording on a Friday, so of course we don't know if there's going to be more bank rescues over the weekend, but I would love perhaps maybe to start off to hear your reaction to some of these things that's taken place in terms of what's gone wrong for some of these institutions, how the authorities have reacted to avoid perhaps even bigger crises, at least for now, but maybe also the speed of how these collapses are happening and maybe even how, I mean, you're a big social media, you've got a massive following, how social media may be playing a role in how quickly these happens. And I'm fully aware I just gave you 4 questions in one, so I will remind you if you forget some of it. But I'm just curious to get your take on current events, if we put it like that.
Yeah, I think it's been a particularly interesting moment. This rhymes with a lot of other times we've seen in the past, but it's different, as you mentioned, because we live in a different time. This was always the point we were heading to when interest rates started ratcheting higher. By definition, increasing interest rates and doing QT means you're taking liquidity out of the system. And when you do it at a historic rate, which the Fed has, eventually, something is going to break somewhere. Somebody, Michael Cow, actually mentioned just a couple days ago, I thought it was a good analogy. It's like playing Jenga, and there's a piece at the bottom you're trying to get out. And, the Fed's been jiggling. That Fed funds rate is that little piece at the bottom. There's lots of examples of, and I've talked about leptocurtain markets, why we live in this much more dangerous kind of world. And it doesn't mean things are going to be volatile all the time. It doesn't mean things break all at once, right? It does mean that there's much more fragility in the system. And it's kind of like a sand mound where we've been removing kind of sand. And at some point, you have that kind of Minsky moment and things kind of break, and can be pretty ugly. Now, so that's kind of the world we live in. So this isn't a surprise, I would say. If anything, it's been very controlled, very kind of the Fed's been ready and waiting for it. They acted quickly. We've prepared also, over a decade 2 decades, right, for another banking run to some extent. It's still an imperfect system, and there's still flaws, and it doesn't mean things can't get out of control. Almost by definition, banks are leveraged entities with a massive tail. So, but I've argued this, and I'll stop here. We can kind of dive in to other topics, but I've mentioned this in other places that ultimately the Fed kind of wanted the air out of this market a bit, and they got that to some extent, at least briefly. Unfortunately, and they've managed the tail as well. I mean, their job is to try and control this volatility, to manage this, and they've been writing, calls in a sense, right? And now they're trying to manage the tail. So we'll get into that, I'm sure, later. But it's been an interesting moment. I think there's been a lot of extreme moves in market that I think are overreactions, and that are going to lead to extreme reactions back. But we'll take it from there.
Yeah, no, absolutely. And we will for sure go back and discuss some of this in more detail. There's a couple of more things I wanted to talk to you about here in the beginning of our episode. I saw this description. I should have written down which publication was. It could have been from Bloomberg, could have been from one of the other digital platforms, but it basically said, history remembers the Federal Reserve Chair's Paul Volcker as the slayer of inflation and Ben Bernanke as the crisis firefighter. But it seems like Jerome Powell is in danger of having to play both roles at once, or what may be worse, to choose between them. Well, in your opinion, because I know it touches a lot of the things that you've been talking about for a while, which one do you think he should focus on if he had to choose?
Yeah, the Fed is in an impossible situation. They have a mandate to control inflation when they don't have, all they have is a cyclical tool that actually, ironically, works across the grain, the opposite way for secular trends. We've talked about this here on the show, but they're trying to control cyclically in the economy against a secular inflationary problem. And Volcker succeeded by being very, very, forceful in his response. But it worked because we were already at the end of that secular trend, not because he was the only person to try that approach, because the two Fed chairs before him tried almost as hard. You could argue McChesney Martin, two before him, did just as much, if not more, in some ways. So, and then Bernanke was, at a moment where Federal Reserve dominance was at its strongest, and we had yet to hit our tipping point of populism, and still had, the Fed still had complete control of markets and wasn't battling the populists or the government that with fiscal policy. This is a very different situation. Neither one of those solutions, right, is going to solve the problem. The problem is structural and just takes time, and it will, if he pulls a Volcker, we will have a massive recession. And the second that we have a massive recession, we will ultimately, they will have to pivot. The political force will be such that they will have to pivot, while at the same time, the populace will pass more fiscal policy, and the response will not be monetary. And that will lead to another kind of at once kind of stimulus, but again, fiscal inflationary push. That's what we've seen in this saw in the 60s and 70s. That's what we will see now. So that's not a winning solution. You get the worst of both worlds. You get a recession, and then you get worse inflation. So I would argue definitely not that being the solution, but more monetary policy at this point, ultimately is politically unpopular and against their mandate. It's actually like they can't do it. Because that inflation is not going away. And we've seen that. We've been talking about that for years. And it's obviously, before transitory happened, after transitory happened, and now here we are again after them, talking about kind of pausing and that things seem to be resolving themselves. And guess what? Sticky CPI and employment numbers continue to come in.
Yeah, no, absolutely. Another thing that I'd love to just hear your thoughts about, of course, on the other series we do together, the Global Macro series, we often debate not just sort of U.S. issues. We look at the whole world. We look at many different things, not just economic things, but what's basically going on from a geopolitical point of view. in the last few months since we last spoke, what are you taking away, or what have sort of caught your attention the most when you look at it from a geopolitical point of view and not so much a, central bank type point of view?
Yeah, so they're all related, right? The reality is that populism is not a U.S.-centric thing. I was just in Iceland and Amsterdam. When we got to Iceland, there was a tourist workers strike, while we were traveling. And then we got to Amsterdam, and there was a sanitation worker strike, and then there was trash all over the streets. I venture to say, if I moved on to the next country, there'd be another strike, and so that is the zeitgeist, and it's a function. Why is that? Some weird coincidence that we all are going through this at the same time? Nobody really seems to talk about why is populism here? Why is this the dominant? And it's because inequality got too far, because of monetary policy, and now we're addressing it, and that's partially generational because, again, inequality is not just rich versus poor. It's labor versus capital, and labor are the younger generation. And so there's a reason these cycles happen again and again. These are structural ways that things are tied. So point is, it's a global phenomenon. When this happens, it actually exacerbates global issues. Not just, it's not a domestic thing, is because protectionism is also, part of populism, right? Labor is domestic by definition. It's the people of a country, and corporations are international for the most part. They trade across. So globalization happens during times of monetary expansion historically, and during times of populism, the opposite happens. And guess what? When you're more protectionist and the world is more protectionist, we're no longer cooperating. We're competing a lot more. Resource scarcity becomes a thing. Global war becomes a thing. And guess what? Here we are, right? So the way I see it is it's all interconnected. This is not a U.S. versus Europe versus Asia thing. This is a global, trend, and it's not going away tomorrow. Unfortunately, these things were built over 40 years, and they'll be unwound over probably 20.
Sure. No, I agree. Final thing I wanted to bring up with you before we talk a little bit about trend and then we go into the topics was I remember last time we spoke, and people should just be reminded this is back in December, where you essentially very accurately, I might add, said, well, keep an eye around mid-February OpEx and expect some kind of pullback. I don't think you put any percentage numbers on, but you thought there could be some weakness after that. And of course, we've seen a 5% pullback or so since that. Now we're getting closer to March OpEx. We have, I think the buyback window is closing in, as earnings season will be with us soon. Is there anything that kind of surprised you or panned out slightly differently from those things you were seeing already back in December to where we are today?
Yeah, I mean, I don't want to toot our horn or do whatever, but I do want to point out too, over a year and a half ago, I think it was in September, we called the January market top at 4,800 within 2 days as well. So these aren't, and people are like, how is that possible? Like the news, it's all about news. It's about the narrative follows price, right? The reason this happened is to a great extent because the market decline was happening and there was stress, which drove kind of some of the knock-on effects, right? Flows are dominant in these markets. We live in a time of broad liquidity. It doesn't take much to support markets, or also the removal of much liquidity to allow a vacuum for things to occur. Again, we're not going to call within days every turn. That's nearly impossible. There's more to it than just the flows. Again, a nuclear bomb goes off in New York City or London, that changes the picture. The reality, though, is those things matter incredibly generally, but particularly in a time of liquidity, which is the world we live in currently. So narrative has followed price. I think the Fed, and we were very vocal about this as we approached that Jan-Feb period, the Fed for a month, mind you, month and a half, was coming out and very vocally trying to talk the market down, and the market continued to rally. And that's, again, the power flows. The market wasn't ready to kind of listen yet, right? But the Fed was out there, and we kept saying they're selling calls. What does that mean? They're out here trying to put a cap on the market and take out the speculation. The market had rallied 20% off the bottom since late October. And that was helping to drive a stronger economy, that wealth effect, right? Helping to drive hotter CPI numbers in a lot of ways. And so, the Fed was trying to push against that. Market wasn't listening. And then all of a sudden, kind of flows were removed and people started talking about it. Now there's this tail, though, right, from the banking, kind of the bank run or whatever you want to refer to it as. And because of positioning now, the other, in other products, particularly on the yield curve, you've seen a historic move in kind of 1 year, 2 year treasury rates. We had a 1.75% move in a matter of a week, 2 weeks. And so that's not what the Fed wants either. The Fed wants the longer end of the yield curve up, right? So they don't stimulate the economy. Again, we've had a relatively resilient property, a construction economy, and now you're massively lowering mortgage rates. That's not what the Fed wants. And so again, there's this cyclical reaction that people have because and algos have, because it's been 40 years of the same thing. It's all been a cyclical game within the context of a secular story that's been the same for 40 years. And so algos right away, under a kind of potential market liquidation risk, crank down kind of yields when there's a much bigger secular story that the Fed is battling against here. And the Fed still has to to battle that. And that's why, going into this Fed meeting just a couple of days ago, we were very vocal. Like, if you expect the Fed to be really, really kind of stimulative and come in here, the market's going to be disappointed. And sure enough, they came in and sold more calls, right? That's what they have to do. And if we keep getting hot CPIs, they'll have to do more. And that is the problem at the end of the day. This cyclical kind of removal of credit that we're so used to remedying this, this inflationary impulse is no longer, working. And it's not going to work, not the way they want it to. And to the extent they blow up the economy, at some point they can do drastic things, which they haven't quite gotten to yet. At that point, there will be other things that will bring inflation back, as we referred to.
Yeah, sure. So we'll definitely dive into some of these topics, I think maybe in even more detail in a few minutes. But this was great, Cem. Good way of kicking things off. Just a quick word on trend for just as a little bit of an update. Oddly enough, it has been a pretty volatile week, but I think to a large extent, trend followers obviously were hit quite hard, I would say, relatively speaking, last week. I think this week has been more. Yeah, there might be a little bit of weakness overall when everything is sort of counted at the end of today. But for the most part, I think a lot of positions actually were being offset, or performance were being offset between positions. And of course, there's been a massive reduction in exposure by CTAs. So in terms of performance, I'm not expecting nearly as big a move as we saw last week. But still, it's going to be a fairly big down month for March if everything closes where we are. But, putting things into proportion, people should just be aware that whatever the losses are this month, there were probably similar gains last year. And of course, the year as a whole was a very strong year. My own trend barometer right now is at 41 as of last night. So that's neutral, but in the weaker end of neutral. And I am expecting today, Friday, that CTA is probably having a down day. Despite that, numbers that I have seen last is as of Wednesday, since we're recording a day early. I don't think they posted the Thursday numbers, and the BTOP 50 is down about 5% for the month, down about 4% for the year. SocGen CTA index down about 6.25% for the month, down 5% for the year. SocGen trend down 7.6, down 7.2. for the year, and the short-term traders index down 1.8 for the month and down 0.2. But as I said, there will be further weakness in the numbers once we finish the week as a whole. Equities still doing fine for the year, up 3.6 in the MSCI World and about 3% for the S&P excluding today. And of course, bonds are having a good month, up nearly 3% for the world governing bonds. Now, you send me a list of, or Chris sent me a list of topics that we should talk about. I heard you touch on some of the things, but I will still put things to you, and then you can decide how much more you want to dive into it. But one of the things you and I don't speak so much about, really, I mean, because volatility is obviously equity related, but it seems like most of the volatility we've seen lately has been in the yield curve. It's been in the fixed income markets. So I was kind of wondering if you wanted to expand your strategy a bit to include some of that, because, it's a pretty interesting opportunity set. Not sure you're going to do that, but as you rightly pointed out, there are some historic moves happening right now. Dive into this a little bit more, maybe from a perspective of how that might sort of change your view on your own strategy, your own field in terms of equities as well when these things happen, or whatever direction you want to go. But I think it's an important area to talk about, because a lot of people, let alone have never experienced, yields going up like we saw last year. I mean, most investors today have never seen this. So that was pretty historic last year. Now we're getting into short, 1, 2, 3 day moves that are, where we have to go back to the early 80s to see something similar. So we can't just say, oh, this is business as usual. It's really business unusual at the moment. So and even in the vol space, I imagine, because perhaps there wasn't much, data to analyze back from the 80s. So how do you make sense of all of these, quote unquote, and I hate to use the word, unprecedented moves that's taking place?
Yeah, so we've done some analysis. You and I have talked about it a bit, about different asset classes other than equities and vol, and how they perform during different environments. And one of the things we highlighted in that is that, and first, last year at first, some vol really exploded as we, and the implied vols exploded with them, and others did not. And the question was at that point, when we were looking several months ago, which ones are, if we believe this inflationary environment to be the case, which ones should remain elevated and which ones shouldn't? And one of the ones that had exploded last year already, but then had kind of pulled back, was interest rate fall, right? And we were very clear that will remain the case. That is not an anomaly. That don't expect that to come back to where it was. Same with FX fall, and those two things are obviously very connected, right? And how are they connected? Because interest rates are cross-national. They affect flows from country to country. The Federal Reserve is ultimately kind of battling kind of money supply here and abroad to deal with inflation. And so FX and interest rate vol both went quite a bit higher. Were fairly priced in our view. Kind of came down from that after a period of placidity. That was an environment, an opportunity to buy in the last couple of months, and not a surprise we've seen kind of another spike. It's going to come in waves. Again, not a surprise. The last time we saw these types of moves were the early 80s. That was the end of the last kind of inflationary cycle. Throughout the 68 to 82 period, that kind of inflationary period, we saw a lot. Just go look at a chart. Interest rate volatility tied to inflation and the Fed, and 3 recessions right over that period. So very, very volatile time. The one that hadn't until more recently participated was gold. We were very vocal when we talked. You probably remember that gold was, in terms of vol and in terms of upside potential, was significantly undervalued. Soon after that, we saw a massive run in gold, and the gold vol has also begun to participate a bit more. So that was an opportunity. It's still cheap, in my opinion. But again, that ties in to this FX and interest rate kind of world. And that part is going to continue to be a point of focus for the markets and volatility.
And I am I remembering correctly that you back then said in particular long-dated gold vol, was that?
Yeah, long-dated gold calls, which again were pretty much the perfect trade at that moment right before gold took off, because vol also increased into that rally, which is not necessarily what normally happens. But that equity vol, as you mentioned, has been very weak recently, and we broadly think that is a broader trend in these periods, because nominally markets, if you think about 82, went nowhere, right? So they had a lot of big decline, like a decent amount of declines and rallies, but particularly long dated vol. I mean, you went nowhere for 14 years. That's a pretty big opportunity. Whereas there's usually a trend, right, in equity markets that's particularly strong to the upside, and that long term can make for bigger upside volatility in markets. The last thing I'll say, the one thing we highlighted as the opposite of gold, which was the vol was overdubbed, was oil. And sure enough, oil's kind of been dead, right? There hasn't been nearly as much, especially on the downside, right? I mean, yes, we got some declines, but they're very controlled. And that speaks to this resource scarcity reality that we live in, where that resource is ultimately something that has an underpinning demand that's going to continue to be in a demand push economy where fiscal is feeding demand. And now that China's come back online, there's a natural kind of underpinning there as well. So longer term, the vol there is likely to be, more subdued than the jump in vol that we saw early in the cycle. And that was also an opportunity. So we do look at not just equity vol. We're very cognizant of these other complexes and opportunities, and we're actually launching a macro vol product this next quarter. So,
okay, yeah, because just when I hear you talk, I mean, there's so many things actually that kind of going a little bit off script in terms of the topics that we had. First of all, just as a comment on the oil thing, I think that a lot of people, probably maybe including myself, is a little bit surprised that where the oil price is today compared with all the forecast people were coming with, in last year, of course, but also in recent months and all of that. That's one thing. But I had a couple of questions. One is, and maybe maybe you don't, that's okay. But one is we hear a lot about, I mean, vol became very popular a few years ago in my world. People were looking at vol kind of almost in competition with trend following as kind of a crisis strategy. I don't want to use alpha, but just as a place to have some exposure should we get a crisis, et cetera, et cetera. The thing is, I'm not so sure that the crisis that people imagined is turning up the way they imagined it would turn up. I mean, for example, we're obviously talking just now about the interest rate. So I'm curious about, is vol in the fixed income space? Of course, we have the MOVE index, right? But is vol in the fixed income space actually something where there are a lot of strategies that people can invest in at all? I'm not personally familiar with any, but I know, of course, there are a number of different vol strategies in the equity space. But what does it look like if you wanted to have exposure to yield vol and stuff like that?
It's a very liquid market. It is actively traded. There's a lot of hedging that goes on, as you might imagine, in interest rate space. A lot of institutional money. It tends to be much more kind of heavy, like kind of sticks to a certain place because there's big institutional flows. And then breaks all at once. It's kind of disjointed as a function of that. But there are big. It was a wasteland. I will be clear, for when interest rates were pinned to zero for a long time. But I highlighted in the derivatives several years ago that like the biggest opportunity going into this inflation cycle was interest rate vol. And so it is a place where more and more people are trying to play. It is a fairly liquid world that you can play in, but with big institutional players where you're sometimes kind of you're getting pushed around a bit. But for secular trades, it's an immense opportunity, and there are plenty of strategies. Eurodollar options are very liquid in particular. But yes, Treasury, I could go on and on, and obviously you can play that for CFAs.
Yeah, but not so many hedge funds doing it, right? More
and more, right?
More and more. Yeah,
there's
fair
a
enough,
lot
yeah.
that got, because it's a very positioning heavy market. There are a lot of people who got stuck on the wrong side of the trade that had some problems, and we heard about that like 6 months, 9 months ago. There were a bunch of deaths and entities that got kind of completely wiped out on some of those first moves. People have readjusted, and vol is readjusted to an extent, and those things happen. But no, there's great opportunities there. Again, something that I think is a place that, particularly the next decade, is a secular opportunity.
Yeah. The other thing, and I'm sure you've been asked this question before, but I think if anyone can, it's you, and that is make a little bit sense of the fact. I don't know how to explain it well, but I think a lot of investors, as I said before, came to vol a few years ago, expecting that this would be a good place to hide out in a situation where we were maybe people felt that we were probably moving more towards sort of crisis periods, not knowing necessarily we would have a pandemic, not knowing that that it would be followed up by other challenges, etc., etc. And again, this is probably more you talking about the landscape of vol funds, not necessarily what you're doing. I think you've probably done much better than most other people, but just generally speaking, if you were to explain and I know also that you have funds that have been they're long vol, but there are other relative value funds, etc. So maybe you need to distinguish a little bit. But I think a lot of people are sitting back with this difficult situation of explaining how can it be that we are in a situation where we have historically changes in interest rates. We have a war, we have deglobalization, we have one crisis after the other, and yet my volatility fund is losing money. Can you help them make sense of that?
Yeah, it's all about positioning. One of our 3 funds is called Dealer Flow. It's about watching dealer positioning, right? And trading accordingly. It is the biggest component. Everybody wants to paint a broader narrative about some macro thing and why it pushed a day-to-day move or week-to-week move or a month-to-month move. For the most part, macro affects things over the longer run, much like fundamentals. The day-to-day, week-to-week, month-to-month, even annual moves, right, are a function of positioning. Again, you and I have talked about this as it relates to kind of a first move versus second move phenomenon. The reality that often people are prepared for the first move, especially with the Fed, which telegraphed kind of that they were going to have to raise rates. There was a record amount of hedging going on, particularly in the S&P 500 at the top in the market. Skew is at kind of record levels. And again, we've talked about this at length, but when the market liquidated, that meant all those hedges had to be monetized. And if you were levered long equities and long vol as your tail protection against it, you not only lost on your equities, but you lost on your vol. And once the losses started coming in on the vol, there's a liquidation, right? Because you're losing on both sides of the trade. Funds are getting liquidated. They were doing both. There's a forced selling component. And skew flattened to essentially a historically flat skew. And that's a function of just people having to liquidate. But a lot of that liquidation has happened, and it takes time for it to happen. That pain essentially forces positioning out, and pain and gain the other way. If people are making money doing something, they do more of it. And if they're losing money, they stop doing it. And it's that simple. People crowd into trades and crowd out of trades. People ask me, when does the dealer positioning fund do well? When does a strategy like that do well? Well, a strategy like that does well once you've been in a trend of some kind. It doesn't mean trend up or trend down. Some type of environment that's been sticky, because that means people are making money doing certain things and they're losing money doing that exact opposite thing. And people crowd into trades, and that makes dealer positioning bigger. And that means at some point, the effects of that become bigger and bigger on supply and demand imbalances. So you said oil, right? A lot of people are surprised that oil didn't work. Guess what? Everybody's been talking about how, the secular opportunity in oil. Well, that's going to make it difficult. in the short term. It doesn't mean the macro trend is not going to play out. It means it's going to be hard. And it's always hard, right? If it looks like an easy trade and everybody's doing it, it's not going to work. And as a trader, if you don't know that, like, you're not in business anymore, because that is everybody forgets about the number one most important thing about, an asset. It's supply and demand, right? Everybody talks about the narrative and how it might be affecting supply and demand, or how it should affect supply and demand. But very few people go look at actual supply and demand. Positioning is literally like a direct effect to supply and demand. And very few people pay enough attention to that. It's critical. So why did it play out this way? Because we're hedged. And why will we eventually get a tail event, much like we have in all of the other major tail events I've been through? It will be because people are no longer hedged because they gave up on vol, which is happening. It's a function of time and losses in vol. It's a function of price and price frustrating vol traders, which all are happening. It's a function of people saying, hey, I bought this. Vol never works, in an volatile time. I bought this for volatile time. And guess what? It didn't work. I'm done with it. And that's what happened. And that's what's happening.
That sounds very familiar to a strategy I know well, I have to say. But let me put it in my own sort of simplistic, non-vol expert terms. Is it fair to say that in the last, say, whatever period, 18, 24 months, I don't know exactly how long, we could observe that say, and again, for simplicity, say the VIX didn't quite react the way it normally would react. So if equities were down, the VIX wouldn't really go up as much, and so on and so forth. But is it fair to say that you feel now that maybe a lot of this has been flushed out of the system, that we may expect that some of these reaction patterns that we've seen before may come back? Is that how to just...
Let's stick with May. It's a function of time. It always takes longer than you expect. I've said this before. Knowledge is vol dampening. If people are aware of things, they are broadly hedged for it. And that means it's less likely to happen. That's why we were talking about the housing market crisis, right? In the US in 2005 and 2006, and it didn't happen until 2008. On a smaller time scale, we knew about COVID in late December, early January. The decline didn't happen until mid-February. We kept getting new highs for like 2 months. People forget that. People think like we learned about COVID and the market declined 30%. No, we learned about COVID and the market rallied, 7%, and then it dropped 30%, right? Positioning is critical. If I sit out here and tell everybody, much like I did about February 15th, to be prepared, this is a bad flows window, you don't get a 15% decline. You get a 5% decline, right?
No. So let me rephrase my question a little here. Sorry to interrupt here, but let me rephrase my question a little bit, because I'm really trying to make this sort of easy to understand. Now, we know from COVID, March 2020, a lot of vol funds back then, obviously with a long bias, made a killing that month, and they've sort of spending most of the time since then giving that back or more. And you could say that, well, okay, maybe some people were a little bit quicker to realize that this could be a major problem, but you could generally say that going into 2020, everything was fine. There's no signs of deglobalization. Interest rates were under control. Central banks were forceful. And then this came kind of out of the blue, a pandemic. So in that sense, you could say you had this massive reaction. So it was the unexpected. But now, let me put it this way. I think the narrative in media, certainly including our little podcast here, we've been talking about that the world is changing. We have a regime change. Everything is much more uncertain. We have deglobalization. We have all of these risks out there. So in an odd way, does that mean that it kind of makes it harder for these vol strategies, as certainly from a long vol point of view, to actually work? Because everyone is on alert. Everybody's uncertain. So they're trying to kind of be prepared and hedged and all of that. Can that simple analogy be used for anything?
Yeah, I think broadly, if people are prepared, it's less likely to happen. The question is, are people still prepared, or people becoming a bit more complacent, or not willing to hedge with vol. What we've seen is markets at the top in Feb 2022 were the local recent top were largely over leveraged to beta and hedging it with vol. And that was because everybody had experienced Feb March 2020, not that long ago, very front and center in people's minds, and said, well, this is the answer to how I kind of take, you don't want to get rid of your beta. And that was a losing proposition. Now, instead of being, 120%, 1.2 beta equities and negative 0.4 beta vol, right? Hoping to get taken out of the tail, right? That's a very different distribution. Now people are 0.8 beta equities, right? It's the same beta in their minds, but a very, very different distribution of outcomes. The 0.8 beta means you lose 0.8 all the way down. Whereas the other scenario, you get, after maybe a 5-10% decline, you get taken out of your equity exposure. And so just a very different distribution of outcomes. And that's where we are now. We are not at late 2017 type vol positioning where the whole world is short and there's a massive tail. We're not there yet. There's a lot of short vol funds that are out there marketing their returns of the last year and a half into a declining market as a diversifier and non-correlated strategy. They did very well into a market decline. Short vol was the trade. And it did well, if you look back in recent history, obviously as well, because the markets haven't had decline. It looks pretty appealing when you only look back 10 years, or you don't really, this couple years, I guess, there's so people crowd in to these trades, and it's moral hazard, and it's more you make money in those, the more assets there are, the more people chase them, and the opposite's true for long fall. So that's where we are, despite the macro realities of the world. And so people will begin to at some point say, well, maybe the macro environment's not as bad as I thought. Look, and there's a reflexive effect to the realized vol. Markets have been very low vol realized as well. So that's, in my opinion, I'm seeing underneath the hood that positioning has changed, and it is changing. It doesn't change from 1 to 0. It's a gradient, right? And it's relative. And just like some of these other things, where's that breaking point? It's going to come eventually, but does it take 6 months? Does it take a year? Does it take 2 years? Generally, it's on the longer end of these things, because in the more, especially top of mind kind of vol is, people are willing to kind of wait out the pain and are more patient. So there has been a big move. People haven't wanted to abandon. It's a little bit more nuanced too. People haven't wanted to abandon all their hedges, but the Vega hasn't been working. The implied vol has been awful, right? So people have crowded into a new type of vol trade because they don't want to abandon all their hedges, which is 0 DTE kind of gamma, because realized vol has been okay, right? There's problems to that positioning. Just like, people broadly think that 15 years we haven't really had, other than a week or two, a implied vol move without a realized move. So the realized move, is a much smarter way to go. Well, I'm here to tell you that happens as well. And just like oil going to negative 30 because of positioning, strange things can happen. And that's a very unbalanced positioning and is having structural effects, which is important to the oncoming prediction. So I would point people to that, to look at that and think, well, how are things going to evolve differently than they have in the past? And, we've been seeing a much more interesting implied vol response lately. And I think we're even, with the macro, dealing with this by the Fed and whatnot, we've seen that response continue to happen. And that's interesting. I'll just highlight that as one of a couple of major positionings that have changed, particularly in the vol market, that maybe give us a clue about how this will evolve in the coming months.
In terms of other clues, Cem, I'm curious about this. I talked before about the pandemic as being kind of a black swan. People didn't expect that. I think there's another thing that could turn out to be a black swan, and maybe we've just seen a little tiny introduction to what that looks like, and that's loss of confidence. I think one of the things that we have enjoyed and investors have enjoyed is an incredible amount of confidence in what central banks have been doing, under control, et cetera, et cetera. A number of years ago, I started talking about that one of the things that I worry about the most is the time when we get to a point where people lose confidence in what we've been doing. We've been dealing with massive amount of debt by adding a further amount of debt and so on and so forth. I think what happened in these banks and with the speed of what had happened or how it happened is an indication of how things can change dramatically when markets lose confidence. So I don't know if you agree with this, that this could be an issue, but if you do, I'd love for you to talk about, but also, is there a way to detect loss of confidence in the markets that you follow a little bit ahead of time, maybe compared to the markets most people follow?
Yeah, I think in particular, confidence in the Fed, right, is...
Yeah. Or central banks in general.
Central banks in general,
yeah.
Correct. Is, there's a broad belief because the last 40 years that the Fed can control the system and the economy. And as we mentioned, there's a secular component that they're likely not to be able to. The Fed, at some point, in my opinion, is going to lose control of the long end of the curve. I think that's going to be increasingly tied to higher vol in interest rates is part of the mechanism that gets us there. As positioning becomes shorter and shorter, vol in those products because it's just too expensive. That opens up the window for more extreme outcomes. Just like we saw a 1.75% move in the one year, vol, you can see that happen the opposite. Now imagine if instead of dropping from 5.4 to 3.65 or whatever it was, now that the opposite had happened. That is a terrifying thing for the Fed to not be able, especially in the face of maybe them trying to control that. So yes, I think I agree with you. The second leg down, I think, will be accompanied by a loss of confidence that the Fed can resolve a stagflationary environment. And that's the truth, that they can't. And if that becomes embedded, and importantly, it's not just that. I want to be clear. We can talk about the narratives of why things should happen, but if positioning, which I was just talking about, gets to a place where, broadly there's less liquidity and more risk to that side, in particular, is when you need to be watchful for that. I think that's coming. I think it's going to happen sometime in the next year or so. And I think that is the major risk. It's likely ironically after a recession or into a recession that it's likely to happen, because that's when positioning is likely to turn and the potential energy of that happening is higher, in my opinion.
And is the clue for something like that? I mean, obviously it would be major. It would be nothing that I think anyone... I mean, there may be a few people who are old enough who've actually gone through a period like that, but I can't really think of a period where maybe in the 60s and the 70s people felt that the central banks had lost control, maybe so, early 80s before Volcker, but very few investors will have gone through a period like that. And is, in your opinion, the way to spot something like that beginning to happen just more vol in long-dated bonds?
Yeah, two things. One, it's a function of vol being loosened, right? So there's this greater risk of this happening. We're seeing that. Two, positioning directionally. A lot of people are trying to hedge for an inflationary response and being frustrated. That's part of why you get kind of these moves. I think when we start hearing a narrative, and this positioning will reflect that narrative of, hey, maybe this is an inflationary environment. Hey, have we entered a deflationary environment? When that becomes central into a coming recession, and the pain, that's when I would be very, very, very begin to be very aggressive in the long end of the curve. Because again, you have to, if you believe in that secular narrative, there were 3 recessions, 68 to 82, and they each were accompanied by, especially early on before it took hold, a belief that, okay, we're done with inflation. And yields came down long into the curve. It took a while for the long-term inflation expectations really to break out. And that really took some time and a couple of recessions where, it kept going higher despite the cyclical responses. And I think that's what's going to happen. And I think particularly into oncoming recession, when everybody's like, look, see the inflation, see we've healed inflation, and it's a function of a cyclical response and not that secular trend. I think that's going to be when positioning gets off sides and ultimately allows for a move there that's going to be very counterintuitive. I think the key is it's got to be counterintuitive. The moves that work and vol are almost always, in some way come at a counterintuitive moment, or when people have given up hope, or, that's by definition what volatility is. If people are prepared for it, it's not generally a volatile event.
Today you and I are allowing ourselves to really speculate and come with all sorts of ideas of what could happen. One thing that is pretty sure to happen in the next 18 months, I imagine, is we're going to have a U.S. election. In your world, how does a period leading up to an election, how does that play out, if at all? I mean, how do you think about, or do you think about that already?
I absolutely do. And actually, it's top of mind for us because other people aren't talking about it. I'm so glad you brought it up. It's the thing that is going to be the next narrative and the next important, not just narrative, but reality. So the critical piece of that is that fiscal policy is front and center. So to the extent that it's taken a pause, the absolute worst thing that could happen for inflation, in my opinion, is a big recession here before the election, and then you're just going to get a fiscal wave, right? And ironically, last historic narrative that we're talking about here, that would also be the moment when people like talking about, deflation, and that CPI has been, fixed, So it's very front and center to how I'm thinking about this. We'll see. Timing is important. I think regardless of whether we get that big or big enough recession to serve as the crisis excuse for the greater fiscal, we're going to get some either way. So I feel pretty good about the broad trend there, the secular trend. I think it's politically, the millennial generation on down, is if you look at Biden's numbers, nobody would have thought he'd be where he is now, right? A year ago, especially into a market that's broadly down, that, it's not about the market as much as it's been the last 40 years. It's about payments, and that people on the bottom are actually, more and more able to afford things and relative to others feel like they can. It's about policy, whether it's like forgiveness of or attempts to forgive loans or housing payments, or, you go on and on, the fiscal response. So expect price controls if we have inflation, which is fiscal. And if inflation's coming down, just expect outright kind of support for the economy, but heading to kind of the bottom of the distribution. And I think that's going to be a very important component of where we're heading. Whether it's Biden that gets elected or Trump or, DeSantis or whoever you're looking at, it's all populist at this point. And you better believe there's more protectionism, more onshoring, more fiscal response, whether it's healthcare, education, defense, like all of it's going to be increasing here going forward, in my view. And again, the worse the economy does, the more we're going to get in the short term. So buckle up.
There's one thing, and I don't know if you have thought about this, but it's something I overheard in another conversation. I actually thought, haven't really thought about that myself. And it's a topic we haven't touched upon, even though I think actually is pretty important, and that's the U.S. debt ceiling. And someone was just reminding everyone that actually what happens is that as long as there is no agreement, they can operate with this emergency policy, which means that Janet Yellen doesn't have to fill up the coffers of the Treasury. But as soon as they agree, they have to issue a bucket load of bonds to fill up the Treasury account or whatever it's called. Is this a deadline, even though it's a few months away? But these negotiations, I don't follow it closely. I have no idea where it is, but it usually gets resolved like in the 1 minute before deadline. But is this something you also pay attention to?
Yeah, very much. No, I'm glad you brought that up. This is likely to become a period people wring their hands over because, again, election season is coming and posturing and everybody grandstanding is part of that, right? There, people are going to try and, have their mountain to build their brand on, right? And so there's going to be a real battle here over it. That said, it's not politically good for anybody who's an incumbent, right, to have this. It's all about incentives, right? It's always about incentives. And so it's not in their best interest to not figure it out. So they will figure it out. They will have to. Otherwise the fingers start getting pointed and none of them win. So that's what will happen. So expect as tends to happen, some volatility going into that, and for it to kind of be the last second and there to be a resolution. That said, to your point, the TRG or the Treasury's kind of funding of things until then, the emergency funding has actually been stimulative underneath the hood. It's been kind of reversing a lot of the effects of QT to the market because there's just not a supply of there's treasuries right on the market. And to your point, when that happens, supply and demand, which is the ultimate most important effect, does get out of whack, and that will be a period, in my opinion, where we're also likely to start seeing some more interesting potential supply-demand imbalances on the yield side. So yes, something to watch, something that there's a lot of talk about. So, the more talk you hear about it, you got to be careful. But to your point, it's about supply and demand and, at the end of the day, where these things are getting priced. And to the extent there hasn't been enough upside pressure in yields, some of that is just we've had kind of secret QE behind the, curtain that's been, helping out. And that's likely, again, to dissipate and be one of the components that could really lead to a greater imbalance and push things the other way.
I mean, if I was going to sum up what you're saying, and with the very big chance of me getting it wrong, it sounds like you can actually think kind of, if we just stick with equities, that we may get some counter trend rallies along the way, but overall the trend is probably in the bigger picture heading south. Would that be fair?
Don't fight the Fed. I mean, that was when markets were going up and the Fed was selling puts. The Fed put was in place. That was the answer on a secular basis. Yes, you had counter trend drops, and opportunities to buy, et cetera. But now the opposite is true to a large extent. And again, just don't ignore when the tide is going out. And even if cyclically we get a little blip the other way, that doesn't mean we're not in the same cyclical world. We're not still playing the same up and down within a very controlled Fed dominant environment. There's a different entity in town which changes everything, which is the government and fiscal policy.
Cem, anything as we wrap up? I mean, anything that we forgot to talk about? Anything you want to bring up before we wrap up? This has been super fun and useful and extremely insightful. So really appreciate your time today.
Yeah, I've missed our conversations. These are always fun. So two major kind of things going on in positioning. I already referenced one of them in passing, which was Gamma versus Vega. People broadly aren't exposed to implied vol anymore. They are trying to hedge it with more realized vol. 45% of options volume is now 0 days to expiration. Again, it's everywhere. People are talking about it. I don't want to spend a ton of time on it, but I think that component is likely to mean, in my opinion, that Gamma stops working as well, which is kind of what we're seeing. We're getting a lot of just back and forth, but not but that the Vega starts creeping higher. And I do think that's something we're broadly seeing. I think there's a greater opportunity in skew. Skew's gone significantly higher, and tail. Again, I think by the time the event happens, hedging will have costs will have gone up where you need it. In a broader, longer kind of, call it a 1 year plus type prices. Think of an 08 or a 2000, 2001. Long-term vol can make some crazy moves that are not necessarily rational. At the end of 08, in early 09, 10-year vol traded 60. 10-year variance swap traded 60. The long-term average is 17.5. That makes no sense. It's irrational, but it happened because people were short it and it went higher and they had to buy it back. Equally as, insane is in 2007, it was trading 15, right? It's a lot about positioning at the end of the day, and that lack of positioning in Vega, I think, is particularly important into what's a broadly secularly dangerous period. It won't happen right away, but the opportunity set's growing there. Gamma is likely, because that's where people are kind of positioned, a little likely to frustrate hedgers that are doing just realized washes. That's one. Two, the other one we didn't talk about yet, which I think is very important. This move in duration versus growth versus value, Russell versus NASDAQ. We've seen some really incredible moves the last couple of weeks. We broadly call that. Why? Because especially going into March, OpEx is when it started to accelerate, because there was a massive amount of put hedging, both in retail and speculative hedges in the NASDAQ, because that's what's worked. People crowded into that because it was working. Short call, long put there, whereas nowhere else has had the hedges and people have started to abandon it. Guess what? Into the decline, you've actually seen massive NASDAQ strength, which is counterintuitive to a lot of people. And you all of a sudden see value kind of really have problems, particularly small cap value. That's a function of positioning. That positioning is still strong. People are still kind of caught in that trade, and until that resolves itself, that could continue. Those two things are also connected in the sense that when volatility does tend to increase, you tend to get correlation going to one across assets or more. And some of the assets that were under hedged, right, tend to, despite kind of maybe safety or lower beta, can sometimes be much more dangerous. And I think, into the next decline, if and when it occurs here, if it is a volatile decline with Vega going, a more applied vol focused decline, I think is likely to continue to see, again, maybe not the NASDAQ as much as some of these other kind of oil names and these places where people have been hiding, counterintuitively be just as painful, if not more. And so I think that's something to watch. I've been talking about that for a couple of months, so we're starting to see that happening. That's a function of positioning that's taken kind of a year to reverse to these positions, and now I think you're going to be forcing people out of those positions going forward.
Cool. Well, I'm glad you brought that up. This has been amazing. Luckily, you and I are recording another Global Macro episode next week, so that's going to be fun. So it won't be long before people can listen to you. But of course, if you do enjoy these episodes, then why don't you head over and leave a rating and review? It only takes 5 minutes and it's easy to do. And if you don't know how to leave a rating and review, then you can go to toptradersunplugged.com/review and you have all the instructions. I hope that's not too much to ask. Questions, of course, next week, you can send them in because we're going to have Andrew Baer back. So I'm sure we're going to be tackling some trend following and CTA replication topics with him, and I'm sure some other things. But if you have a burning question, send it to info@toptradersunplugged.com. That's it for today from Cem and me. Thanks ever so much for listening, and we look forward to being back with you next week. And as usual, until next time, take care of yourself and take care of each other.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.